Hi there. Thanks for tuning in. Today, I'm going to be doing an analysis and valuation of Eurocash Group. Now, what is Eurocash Group? If you don't know them, they're essentially a Polish conglomerate and they own a lot of things. For example, they own Eurocash Cash and Carry, a retail chain. They own basically the companies that provide the or distribute the packaged goods to petrol stations, to hotel, restaurants, and catering companies. They also own, for example, Pay Polska, which essentially has a pay and go app for mobile phones. So they do retail, they do distribution, they do services. That means they do pretty much a little bit of everything. They're a pretty big company in Poland with a lot of fingers and a lot of pies. So that is something that I kind of like to see. No one decline in any sector will significantly affect Eurocash's top and bottom lines, but it's also something that has to be sort of evaluated as a whole, and we have to see also what is their greatest growth drivers and their greatest revenue creators. So right now, that seems to be the retail chains and their wholesale. So that's important to see. Now, recently with the Q3 2023 reports, they have had an amazing increase in net profit, a pretty good increase in operating cash flow. That's pretty great. And their net debt to EBITDA seems to be going down. We'll talk a little more about that. But yeah, so their cash balance seems to have doubled too. That's awesome. They can do a lot with that cash. They can pay down the debt. They can issue a dividend. They can buy back shares. So that's what we like to see overall. They also seem to have a 7% increase in EBITDA amid pretty slow retail sales in Poland. They have a slightly increasing sales margin, which is wonderful, and their sales margin is certainly improving. So this is just an overall good picture in a quarter where the rest of the economy slowed down. And this is something to note. CPI is still pretty high in Poland. Look at that. It's over double digits. Now, retail sales growth, on the other hand, has been pretty low in the last couple quarters. The sales of stores from up to 500 square meters has been down. And here is a very fun graph, which is actually the changes in air temperature versus the number of transactions in the wholesale market. Generally, it's very correlated to temperature, which I think is very insightful. But now, temperature had been a lot colder, and now that it changed big time, it went back up, but still relative to previous levels, retail sales have been low. Now, it's also interesting because Polish GDP growth has been very strong. Poland's economy is actually notoriously high growing within the Eurozone. However, CPI is still way higher than that, and retail sales growth is way lower than that. Amid this picture, though, we still see that Eurocash is pretty good looking so far. This is basically a pretty cool graph where you see the red line is the average number of products per basket. When I check out how many products do I have there, which stays pretty stable at around that 4 level. Then you have the average basket value, how many Polish zlotys is the person paying when they check out with for those 4 products. And then the other is the number of transactions. So you see here in September 2023, which is the date where this report was issued, relative to September 2022, this went up. So there's a little bit more transactions, and the average basket value has increased by 10.5%, which is that more than CPI? Not quite, but for CPI, for food and tobacco, it's also even higher. So it's not keeping up with it, but at least they're able to pass some of it on to the consumer. So slightly higher prices and more number of transactions, that's good for them overall. And this picture is great because overall the basket value has been going up. Overall, in the very long term, the transactions, you see these low months here that weren't as low in 2023. So the average basket value is actually going up and the transactions are going up or trending upwards. So that's what we like to see. And here you can also see very clearly the trend of, like, in the very cold months of January and February, less people go to the grocery store. So that's just important to see. And slightly more people buy, or there's slightly more products in the basket. That makes sense. So we also talked about the debt situation. They seem to have been paying down the net debt to EBITDA. However, this has been adjusted. The accounting rules in the EU certainly have adjusted their metrics. So they want a level below 0.9% before IFRS 16, which is these accounting rules that have them recognize other things as debt. However, they're still below that 3 times level after IFRS 16, which is great. We want to see basically a below 3 times net debt to EBITDA. Why? Because in case they have to liquidate everything, in case the company goes bankrupt for some reason and they have to sell absolutely everything, the first people to get paid are essentially bondholders, banks, and then if anything else is left, then the shareholders get paid. So that's why we want to see this kind of thing. We want to see a lower level of net debt to EBITDA. However, it's cool to see that they have prioritized paying down some debt. Hopefully that continues, although we don't know. Now, I want to get a quantitative model to tell me how much it's worth. I'm going to do a discounted cash flow model. Essentially, what I'm doing here is I'm going to lower the free cash flow a little bit. In 2022, they had a huge amount of free cash flow. In 2023, I'm going to be a little cynical, say they still do great, but they have a little less. And then after that, I'm going to grow it from 2023 to 2026 at 3%, and then after that at 2%. Okay, that's all I'm going to do. Very simple model, sort of saying, okay, they are a company that knows how to grow. However, the Eurozone doesn't grow too quickly, especially compared to certain peers like the United States or the developing world. So 2%, it can't be more than that. And also, my required rate of return is going to be 12.5%. We'll talk about this later. But with that said, if we divide that by the total number of shares out, we get a fair value of 44.56 Polish zloty. However, then if we subtract the net debt, it's actually 25.31 Polish zloty. Now, notice that this is in Polish currency. You would have to convert that to US dollars and compare it to the ADR if you're buying it in the US, or to euros if you're buying it in euros. So that's just something to note. But here we're just grabbing the stock in the Warsaw Stock Exchange to compare directly currency to currency. And right now we're trading at 16.86. So that is significantly less than this number. And that's important to note that if you've been a shareholder since they became public, you're probably not very happy. Now, the Warsaw Stock Exchange hasn't had a great time in general. This could be a time to look at those opportunities of those stocks that are very depressed that everybody hates, and seeing just what's up, how can they grow, what can happen with them. Okay, their market cap is not huge; it's 2.35 billion. Their P ratio is a little elevated. That's because generally they have way more free cash flow than they have net income. So that's just something to note. Companies with high P can still be value companies, especially if their free cash flow at the end of every cycle is higher than their net income. So this is just something to note. And in general, it seems undervalued. Now, it's looking good, but the currency risk is something that can affect Eurocash shareholders abroad. Right now, with a new government, the Polish currency has been very strong. However, it could start weakening after such a roaring effect for the currency overall. Eurozone and inflation recession risk is still a very real risk. The inflation in the Eurozone has stuck around a lot more, especially more compared to the USA, for example. So inflation is going to keep affecting the Eurozone. And recession, look, Poland's economic growth slowed sharply to 0.2% in 2023. That's important. And you have technical recessions in Germany or the UK, for example. So that's just something to note. If there's less money coming in, there's less jobs, then Eurocash is going to suffer a little bit. So that may be maybe a shorter term headwind, but it's something that you have to keep in mind. Now, I'm accounting for a lot of this with a high rate of return in my calculation as I invest in US dollars. So I am saying usually I want an 11% rate of return, which if I were to change this to 11%, it means I can invest at a higher price to get that return. So the value of this would go up. I changed it to 12.5%. I could do even more, just to account for the extra risk that I'm taking on for investing in a different currency and maybe in a slower growing area. So it's just something to note here, but you can account for it in different ways. You can add a margin of safety, for example, where you get a fair value and you say, okay, I'll only buy 20% below this, something like that. So that's also important to note. A small dividend yield, yeah, it exists. It's like 2% here, 2.14%. But there's no share buybacks, and so value at the end of the day will primarily come from increased free cash flow and debt being paid down. Those are the two primary drivers of value. If you don't believe that they can increase free cash flow at a satisfactory rate, if you think this is not going to be 3 and 2%, but rather be flat, then this may not be as interesting of an investment. Or if you think that the debt position will increase for some reason, maybe they do another acquisition, But if that acquisition doesn't bring back as much in revenue, then it may not be worthwhile. So that's just something to note, what the value drivers are, something you always have to know when you invest. Now, overall, Eurocash looks very, very interesting. And I think for those who want to diversify and maybe add a stock in the Warsaw Stock Exchange or something like that, it could be a very interesting opportunity to look at, especially now that it seems to be a stock that has been battered down and could recover soon. Now, overall, the lesson I'm taking here is to look to other markets too. There's such a thing as home country bias, and it's important sometimes to just look to other markets. Investors in the US or Canada may not have even thought about looking at the Warsaw Stock Exchange, but I bet if you take your time to look through some businesses there, you'll find very interesting opportunities with very good prospects. Now, with that said, thank you so much for watching. I really, really appreciate it. I want to thank you so much. And if you like this, please don't forget to like and subscribe and recommend stocks you want me to look at in the comments down below. Thank you so much and have a great rest of your day.